Agora a gente vai falar com um expert no assunto, o John Reade. Ele que é especialista-chefe de estratégia de mercado do World Gold Council, a principal entidade global para o setor de mineração de ouro. Ele que vai conversar com a gente direto de Londres. John Reade, welcome to Aura Day.
Thank you very much. Just unmuting myself. Well, thank you for the opportunity to talk to you today. I'm going to run through a presentation which will last about 15 minutes on the gold market. And if I could have the next slide, please. Okay. So this slide should be talking about the World Gold Council, which is the organization which I work for. The World Gold Council has, okay, next slide, please. Perfect. So the World Gold Council is a global authority on the gold market, and we are a market development organization owned by about 30 of the most important gold mining companies around the world. Our job is to allow better access to the gold market from investors and other buyers of gold. And we do a number of things to do this. Increasing understanding by providing top quality research, data, analytics, and demonstrating market knowledge are all areas that fall under my responsibility as Chief Market Strategist. But we also work to improve market infrastructure and to try and make policies more favorable for gold investment around the world. Next slide, please. So I'm going to start off by giving you the short presentation that we use to speak to investors to explain why gold should be part of pretty much every portfolio all of the time. And it's called the strategic case for gold. Next slide, please. The first of these arguments is because gold delivers returns. A lot of people think you should own gold if you're worried about inflation or you're expecting a financial crisis. And while it's true gold will do well during those circumstances, it's more than that. If you look at the performance of gold since 1971 or over the last 20 years, it's delivered average returns in line with or better than other major asset classes. Even over the last 10 years, gold has delivered 4% annual returns per annum, better than some assets, worse than US equities, for example. So gold's been a source of returns for a portfolio. Next slide, please. It's also a top quality diversifier. And what I mean by that is not only has it delivered returns, but the correlation of those returns is not related to other assets. So generally, gold moves independently of equities, which is good. You want that in a portfolio. But there's more to it than that. If you look at this chart here and look at what happens when the US equity market, the S&P 500, is up by more than 2 standard deviations in a week, gold is positively correlated to equities. But when the S&P 500 falls by more than 2 standard deviations in a week, that correlation flips negative. And that move to a negative correlation is really useful because you want to be negatively correlated to something that's falling very fast. Now, we've looked at all other asset classes, and none of these demonstrate the same flip over. And I've shown here what commodities do. So commodities aren't very correlated with equities most of the time, but when equities are falling fast, that correlation increases. So you're now correlated to a very fastly falling market. Not what you want at all. Next slide, please. Gold is a liquid asset, so you can get into it and you can also get out of it when you need to. Approximately $180 billion of volume turns over in the gold market every day. About 2/3 of that is in the over-the-counter market, centered in London, but 30% of it is on exchanges around the world, such as in America, in China, in India, etc. Finally, gold exchange traded funds contribute a few percent of the overall turnover. So that $180 billion a day is more than many other major asset classes, like the UK bond market, like the Dow Jones stocks, like the German Bund market. So that source of liquidity is really important for a portfolio. Next slide, please. Gold is not as volatile as most people think either. I often read news stories talking about how gold is a very risky asset or how it's very volatile, but that simply isn't true. If you look over the last 20 years, the average volatility of gold has been in line with emerging market equities, US equities, and lower than any other individual commodity. So yes, it does move more than the bond market, but everything does. But other than that, gold's volatility is in line with or lower than other asset classes. Next slide, please. Gold also has fulfilled a role in portfolios during difficult times. So each of the events that I've shown on this chart represent market sell-offs of some form or another. We've got the 9/11 attack on the United States. We've got the sovereign debt crisis in Europe. And in all cases, pretty much, gold has performed well, or been one of the best performing assets, protecting a portfolio during these crisis periods. Next slide, please. So how does all this contribute? Well, if you add returns, diversification, correlation, liquidity, volatility, and protection from downside events together, then you find that adding gold to a portfolio has a positive impact. Now, this particular example here is taken from the United States markets, and it takes a typical US pension fund over the last 10 years and shows the impact of adding a little bit of gold, 2.5% or 5% or 10% of gold to a typical pension fund portfolio and reducing everything else in proportion. And what you can see is adding gold, probably on this example, about 5% of gold to a portfolio is the sweet spot. It increases the risk-adjusted return of that portfolio by contributing to a little bit to returns, but also from the diversification of the portfolio protection that it offers. Now, we've conducted this exercise in many markets around the world, in Europe, North America, Australia, Singapore, Russia, India, China. And the answer we get is very similar. Somewhere between 4% and 8% is the ideal allocation to gold based on its performance and the performance of other asset classes over the last 10 years. Next slide, please. So aside from the strategic case for owning gold, what's happening in the gold market at the moment? Next slide, please. Amongst the work that we do, and I should add, all of the research that we do is contained on our website, gold.org, and is available for free. But the research that we do includes an analysis of the drivers of gold price performance. Now, this shows you the positive and negative factors that have been driving gold this year. And you can see in the first 6 months of the year, risk and uncertainty, and then opportunity cost, which we divide into two categories, foreign exchange and interest rates, have been the major drivers of the market. Latterly, it's mostly about opportunity costs, and again, interest rates being the major driver of markets. Next slide, please. Because what's happened over the last 12 months is that gold has underperformed many other asset classes. If you look back in 2020, having gold in your portfolio was a clear positive. The return was around 25% for the year in US dollars. in a year when most other asset classes fell. But once we started to get positive news about vaccines and investors started to anticipate a recovery in the global economy, other asset classes did better. And that's what we've seen since August last year. We've seen gold underperforming equity markets, and we've seen gold underperforming commodity markets as well, which is a clear sign that the reflation trade, the recovery from the pandemic crisis, has benefited other assets rather than gold. Next slide, please. And research that we published on this earlier this year shows this is entirely normal. In the first 6 months after the end of a US recession, gold tends to underperform other commodity sectors and other equity sectors too. So you see much better performance from energy, from industrial metals, etc., whereas gold tends to languish. But what you see is if you hold gold for longer than that, if you hold it over a 12 months or a 2-year or a 3-year view, then the performance of gold is very much more in line with or better than the other commodity sectors. So the early stages of an economic recovery, gold underperforms. Typically, gold catches up over the longer term as well. Next slide, please. So I'm going to talk a little bit about the fundamentals of the gold market now, because it's important to understand what's driving the market at the moment. This slide here shows averages over the last 10 years, so it strips out the very specific events that happened in 2020. In general, about 40% of gold demand goes into consumer purchases, whether that's jewelry or technology. And 40% of that demand goes into investment. And finally, 17% of the demand is being bought by central banks. So you have a very balanced market here, one where some things are driven by economic growth and some things are driven by uncertainty. Next slide, please. So where we stand now, looking at at gold over the first 3 quarters of this year, we've seen a return to normal. Now, what I mean by that is last year saw the gold price up 25%, driven by extraordinary investment demand as people were looking to protect themselves from the coronavirus pandemic. At the same time, we saw a collapse in consumer demand, and consumer demand collapsed because markets were closed. People were losing their jobs. They weren't buying jewelry or able to buy technology. So this year, we've seen a recovery. The gold market is returning more to normal. Jewelry demand has recovered. Bar and coin investment, and by bars I mean the little bars, not the big James Bond bars that we see in the films, but bars and coin investment remain strong as retail investors are concerned about the outlook, particularly for inflation. But the big negative we've seen this year is investors who bought lots of gold via exchange-traded funds last year, helping drive the price to all-time highs, have been taking profits on those positions and reducing their holdings. And that fits very much with what we've seen in terms of playing the reflationary trade I mentioned before. Central banks have stepped up and bought more gold this year. They were a little constrained last year because of the economic impacts of the coronavirus pandemic, but they're back and they're buying good quantities of gold this year. And the final point I'd say is mine supply was affected by the shutdowns because of the coronavirus pandemic last year, but mine production has bounced back strongly in 2021 and looks like it will hit an all-time high. But total supply to the gold market looks as if it will be about flat because the amount of recycling of old jewelry has fallen back quite a lot. Next slide, please. I mentioned central banks before. They are an important component of the market, contributing 17% of net demand over the last 10 years. But it wasn't always like that. We've seen 27 years of selling by central banks up until 2009. But after the global financial crisis, central banks stopped selling and emerging market central banks started to buy. And that's continued every year since then, even last year in 2020 when we didn't see quite as much buying. This year has seen some of buying from the usual central banks to buy, but also from some unexpected purchases, including Brazil, Thailand, and Hungary. So based on the conversations that we have with central banks, because we have relationships with approximately 94% of the central banks in the world, we expect these purchases to continue in coming years, and they're an important supportive factor for the gold market. Next slide, please. I mentioned mine production because mine production has grown strongly over the last 10 years. Lots of analysts, however, are beginning to expect to see gold mine supply slow down its growth and maybe even start to decline going forward. That may be the case. We've looked at an analysis of projects and new mines that will be coming into production, and it's going to be difficult to sustain the levels of production of the mining industry with the few new mines and projects coming on stream. But this year probably sees mine production hit an all-time high. So we may have another year or two of growth coming through before we think there'll be a slow, steady decline. Next slide, please. But as I mentioned earlier, recycling looks as if it will prevent total supply from increasing very much, because recycling is very sensitive to the gold price. We saw a big jump last year because of gold prices getting to all-time highs, but it's rapidly slowing down now. And we think that's because it's too soon since the last spike in gold, which happened in 2011, for large stocks of unwanted jewelry to have amassed in people's homes. And it'll require a much higher price, we think, to make recycling demand increase rapidly again. So my final slide is a brief conclusion. I've only had 15 minutes or so to talk here, and I've been in the gold market for 35 years and can talk about gold for hours and hours. I would encourage you to go to our website, which is free. All the data and research there can be read, and it gives you lots of insights into what's going on and what we expect to happen. But I conclude by saying the gold market's normalizing in 2021 after the shock that we saw last year that resulted in the all-time high in the gold price and the collapse in consumer demand. So that normalization should continue in 2021 and into next year as well. Central banks will keep buying. We expect ETF investors will probably return to the buy side in 2022 as well, particularly if the inflation that we've seen worsens or turns into stagflation. That could be a big upside trigger for gold. But if central banks are able to hike interest rates and to normalize monetary policy without crashing the economy, there is the potential, I suspect, for downside in gold. And on the production side, we think that mine production will hit an all-time high this year. And although the medium term does look for declines in the price, declines in production levels, that's not going to happen this year or maybe not next. But recycling should stop the gold market from being inundated with supply. So I'm going to stop there, and thank you very much for your time, and thank you.
John Reade, thank you for being with us here today. Thank you for your explanation.